Hey, welcome investors to the 40 Finance channel. My name's Jeff Beers. Today I'm going to share some investing strategies for stocks that you can use in 2021. We've already gotten through the first couple months of 2021, and there's some patterns that have emerged that I think will stick with us throughout this reopening year. It's a very exciting time for the world after what we went through last year, but it's not going to be as easy to navigate the winners and losers, in my opinion. So I hope some of these strategies at least give you some benchmarks to think about when you go about buying stocks this year. Reminder, as always, that my stock picks and projections are just my opinion for your entertainment. Please make sure you do your own research before investing in any stock. And of course, if you like stock market videos like this and other personal finance topics, please subscribe to the 40 Finance channel. Give this video a like. Thank you to everyone for all your support. All right, the first stock investing strategy for 2021, in my opinion, is to get greedy when you're at the top. Recognizing the top this year is going to be very important, and understanding what your goals are as an investor. Know what your exit strategy is ahead of time. I know for me, if it's a cheaper stock, let's just say a $20 stock or under that, somewhere in the neighborhood of 100% returns, start to get very serious about my exit strategy, right? Because 100% gain is nothing to sneeze about, and it doesn't just happen all the time. Not every stock goes up forever. So knowing in advance when you're going to make a move and really trying to understand when your stock is getting into overvalued territory. All right, and to illustrate this, I'll use one of my stocks, PayPal, which I love, and by the way, I'm not selling. I'm holding it for the long-term future. But if I was not a long-term investor and I was concerned about the stock going down, there are some easy things that you can look at to give yourself an idea of how a stock's running, particularly in a stock like PayPal, where you have an EPS and a PE ratio, aka it's a profitable company. You can just go to Yahoo on the statistics tab here, and I'm a premium member, so my data goes back a little ways, but I think that if you're a free member, you get this quarterly tab. Just eyeball the trailing PE over the past several quarters. All right, so right now we're at 73 and recently at 88, 90, 100. Guys, look back to the recent past, say September 30th, 2019. This PE was under 50 for the trailing PE and really held there for a few quarters into the COVID dip. Then you shift down to the forward PE, and it looks like, it had a pattern of 29 to 30, something like that. Today, we're in the 57 range. So this would be one where if I wasn't interested in the company long term, I'd have to feel pretty good that I got the bonus of the price going up and people willing to pay more in this current world where we're at, where there's not a lot of other options. But it really shouldn't surprise me. I shouldn't wake up tomorrow and expect or assume that PayPal is going to go up on a given day, because we see what the metrics tell us about the history. When it comes to the last year or so with investing, I subscribe to the TINA theory, and that means there is no other alternative. And what TINA theory basically states is we've got a ton of people piled into the stock market, mostly because there's no other investment vehicles. There's another leg of the TINA theory with stocks lately that you could also argue people have been locked in their house, and from an entertainment, gambling, you name it perspective, the alternatives in the world over the past year were very limited. So just keep in mind that as other options open up for investors, whether those options are other forms of investments, other stocks, things like that, the high valuation stocks are likely going to pull back a little bit, and that could affect their price even if the company's doing good. The whole concept of any valuation multiple is just to show you how many X times people are paying in advance for that metric. So it doesn't matter if it's price to sales, P ratio, market cap, all those things, but they are all tied to a core fundamental. And as people pay less for that valuation, the stock price comes down. So recognize where your stocks sit across multiple valuation points and be honest with yourself when they're getting hot. And if you notice your stocks are getting hot, potentially get greedy, selfish, whatever, take some profits for yourself. We don't necessarily know if the market will continue to trade at these high valuation multiples. All right, strategy number 2 for investing in stocks in 2021 is to keep interest rates and Bitcoin prices on your radar when you're evaluating a stock. Interest rates have long been sort of a storm cloud over the stock market. But with the way a lot of people are jumping into Bitcoin, particularly at the corporate level, we have to keep into consideration what happens if Bitcoin dips some, what happens if it goes up even higher, like many speculate. Where does that impact stocks? All right, if you use Yahoo Finance like so many other people, it's very easy to keep track of interest rates and Bitcoin for that matter. There's this little slider bar at the top, and if you just sort over, you might even be able to adjust this. I just know for me it's on the second tab. You have the 10-year bond, which is also known as the TNX. So here's the TNX. And as the TNX goes up, stocks start to get spooked a little bit, particularly in this world where we've had essentially zero interest rates for a long time. This is a 5-year chart. Let's take a look at the 1-year chart. All right, you see here where the interest rates kind of started in the pandemic at 0.9, and then they went all the way down into the peak of the pandemic and lockdown. You were at 0.5, but they are inching their way back up. And if you think back to January, basically the first couple months of this year, you know that the market's been a lot more volatile this year, certainly as we aim towards reopening. But look what else has happened. These interest rates are ticking up in the 10-year. And here, just in the last week or two, as I'm recording this in early March, the TNX is much higher than we have seen even before March of last year. Now, one of the things you can do to compare your stocks with TNX is, let me just put Amazon in here just to pick one real quick. You go to the full screen view on Yahoo, which is the full chart, and you can add a comparison. And I'm not sure if it's going to be in here. Oh, yes. So I started typing in interest rates, and TNX came up right away. So we'll click that. We'll just make it a red line for fun. And you can see Amazon's stock price. I know there's a lot of other markers on there, but you can see Amazon's stock price as it relates to interest rates. And we are coming to an interesting time here where this interest rate is actually up 32% over the past year. And Amazon's sort of been a flat to low funk since it's started to make its upward trajectory. But the most important lesson here is to just understand that the TNX puts pressure on stock prices and can drag it down. It doesn't mean that it's a crash or anything like that, but you should be monitoring this metric certainly daily if you're trading daily. And if you're a long-term investor who just makes a couple investments a month, you should be looking at it a few times a month and at least get a feel for what the trend is going. Now, on the other side of interest rates, we have Bitcoin prices. Now, Bitcoin prices are not going to impact every stock, but we are seeing more and more companies add some level of Bitcoin to their balance sheet. So right off the top of my head right now, you've got Tesla and Square, both of which are very popular growth stocks right now. And you can safely assume that if we see a turnaround from Bitcoin, right now the price is at about 50,000 or so. If you were to see a Bitcoin crash, or let's just say a 20% correction into the 30,000s of dollars, you can assume that will have some impact on Tesla and Square stock only because they've made so much of an investment in it. Now, some of that dip won't even be fair, right? Because it won't represent what Tesla's actually selling, where the majority of their money is coming from. But traders overreact and they think about things too much. And when they see that, let's just say Square has like $150 million worth of Bitcoin, so they'll see the Bitcoin pull back and then suddenly they'll freak out and they're like, oh my God, Square lost so much money on that Bitcoin deal, or Tesla lost so much money. So there'll be an overreaction in place. And that's why even if you don't necessarily care about Bitcoin, you should probably keep track of what's going on in that market. It could give you an opportunity to buy some of your favorite stocks lower if they have a relationship to Bitcoin. All right, strategy number 3 for 2021 is another time-tested and proven concept, and that is DCA, which is dollar cost averaging and or managing your cost basis. So I do a little bit more of the latter, but they all play in the same direction, right? So let's just pretend this is a QQQ, which is a popular ETF. This is a 6-month chart. And let's just say you had $10,000 to invest here on October 12th or 13th. You had $10,000 and you didn't really expect to have a lot more money than that to invest for the rest of the year, right? Sort of like $10,000 was your thing. Now, if you piled it in on October 13th, the QQQ over time was a great investment. However, shortly after investing, you would have seen a relatively quick downturn because you kind of bought it at this peak here. What I would encourage you to do if you're anxious to get in the market is maybe just put in 10% or 20%. So $1,000 or $2,000. Get in right here at $294. Let's just say, for example, and you would have woke up over the next few days like, holy cow, that was a bad investment. We're down to $269. Well, that's where you're going to want to jump in with your next $2,000 or $3,000, knowing that you're already saving money on this initial purchase. So you would have brought your cost basis down just by buying the dip, so to speak. And then you can see that there was other opportunities just like that. Now, for me, I tend to manually manage my cost basis just because I look at stocks every day and that's just the way it is. But there's a lot to be said for dollar cost averaging as well. And just saying like, whatever, on the 1st of every month or the 15th, you're going to put in X amount of dollars. Because I anticipate a lot of volatility in the market in 2021, we talked about Bitcoin, we talked about interest rates, we talked about valuations being high. I would strongly encourage you not to do lump sum investments in this particular year, or certainly not right now when I'm recording this video. I would just sort of do pieces, parts. I think that interest rates are going to be scaring the market a lot during the year. And if you can't watch stocks every day, there's nothing wrong with that. You can just pick some different times in a month to slowly bleed into the market under the dollar cost average model. All right, investing strategy number 4 for 2021. Which ones of your stocks are reopening plays, as in the world is beginning to reopen as we have the vaccine, etc., and which ones are tied to high comps coming out of the pandemic? And by comps, I mean the sales for the year before. So without looking at the stock specifically, I'm just going to use Zoom as an example. And to be fair to Zoom, I have not read their earnings reports or anything like that. But we know Zoom hit a huge boon when the pandemic and lockdowns came in place. They made record revenue numbers, record user subscribers, all those things. Phenomenal year for Zoom. And to be honest, I like Zoom as a service, and I think it has a great chance to be a solid company for many years to come. But what Zoom is facing this year, and so many others are facing as well, is they were in this digital world that exploded over COVID, but is now facing not necessarily competition from a competitor, but they're facing the competition of other distractions, right? I don't know how many people will actually go back to the office building this year, but the fact remains for Zoom is their demand environment, it's just going to be less for 2021. There's no way to put it. Now, hopefully they were smart and they've signed a bunch of new companies under contract and they're continuing to deliver innovation. And those people will keep their contracts for several years, and I have no doubt about that. The problem is that new leads and new prospects, which were a dime a dozen last year, are going to dry up pretty quickly because the whole equation has changed on video conferencing and who needs it and who's willing to pay for it. On the flip side of that, you have travel companies like, say, Disney World that are about to get a huge shot in the arm on negative comps that they had last year. Now, Disney's really unique. Obviously, they had the streaming win with Disney Plus, but there's plenty of other travel companies that did not have streaming software to go along with their stock. So they're about to get a huge shot in the arm where their comps are going to be, plus 1,000% over what they were last June. So make sure that you're identifying with your stocks the right side of momentum. Is it neutral? Does not a lot change because of the nature of their business, that COVID just didn't impact them? Is it positive because things are opening up? That would be the case with one of my stocks, TJX, which is TJ Maxx stores. We won't have as many store restrictions, so it's a positive tailwind for TJ Maxx. On the flip side, I own Etsy, which I absolutely love, and just like Zoom, think will do good things for a very long time. But Etsy is going to face sort of declining demand, or at best, par year over year. Now, I'm familiar with Etsy. I recently did a stock analysis video on them if you want to check it out. But I can tell you that Etsy, I feel comfortable because I know that they continue to improve their product. And I'm going to assume that Zoom's doing the same thing. But just know that the momentum is not in favor of either of those stocks, particularly right now as we head before the travel season even kicks in. So when investors are thinking about Zooms and Etsy's, they're going to be thinking about the potential negatives. So any storm cloud that rolls in has the opportunity to get people to jump off the ship. And then what happens is the price just goes down, even if the fundamentals are still strong. All right, speaking of fundamentals, the final strategy for 2021 that I would highly encourage most people to look into, particularly new investors, and that is make sure you're investing in profitable companies that are already showing that whatever their idea is, whatever their use case is, they have been able to produce an EPS. All right, if you're a new investor and you don't know a lot about EPS, this is the Apple stock page on Yahoo. EPS is right here, $3.69. And what you're really looking for with any company that you're investing in is for them to be growing their EPS over time. And there's a really quick trick you can use on Yahoo Finance. Go to the Analysis tab. And while these are estimates, they do provide a good summary of all analysts tracking the earnings estimate. We can look down here. The year ago EPS for Apple, that number was $3.28. Then we're in the current year of 2021. The average estimate is $4.45, so $3.28 going up to $4.45. And then next year in 2022, analysts project, even this early in the game, that will go to $4.68. So what do you got with Apple? A company at $3.28 last year, projected at $4.45 this year, and projected to grow even more next year. So at the bare minimum, when you're looking at stocks to invest in, particularly if you're new, I would advise you to only invest in companies that have metrics like this to look at. Now, just to be clear, I own some companies that do not have EPS. DraftKings is one, just off the top of my head. And I understand the risks that are associated with DraftKings. So I don't want you to think that I'm a hypocrite and I never buy stocks that don't have EPS. I can think of Unity Software, and there's probably a couple others. But that's mainly for new investors. If you just really want to feel good about the trajectory of a company and you want to have a stock that is grounded in a realistic metric that everyone can understand, if you use that EPS strategy to comb through all your stocks, I guarantee you'll feel A, more confident about which direction your stock is heading, and B, more confident about being able to analyze the stock. All right, guys, so those are 5 strategies for investing in stocks in 2021. Should be a fun year. I expect it to be a slightly volatile year. Don't get me wrong, I'm not expecting like an 80% crash or anything like that. I think that American companies and worldwide companies have the opportunity to make a ton of money on the reopening play. So I don't think like earnings and sales is going to be a problem. I think it's just this transition between rising interest rates, stocks that were pandemic plays, transitioning to reopening plays. Long story short, I think you're just going to see a lot of money movement in between categories. So if you use some of my strategies, hopefully they will help guide you along this path and you'll have a great year. Hope you guys enjoyed these ideas. Please give me a like and subscribe if you did. We'll see you on the next video.